Join Samantha and Hans at the next Macro to Micro Options Power Hour, held each Wednesday at 4 p.m. Eastern Time. Registration is free. Scan this QR code or click on the link in the description.
Anyway, I gave the levels as it related to SPX. If VIX goes down into 20, that does not, I think, do anything more than that 50, what did I call it? 57, 67. Dollar yen. I will show the dollar yen because that is a really good point. I like this one as it relates to yen carry trade threatens. I get all excited about then positioning short. We're not there yet. I love to put this side by side, but this is the dollar yen, okay? And this is gold. And we typically do not have such a tight correlation, but man, this thing has been so tight this year. So sometimes that happens and I notice it. And so every single day I'm on this because I can notice that when the dollar yen is moving higher, gold is softening. But big picture, I think we need to break very specific level of dollar yen, 139.39. And we have to get and stay below it. I know I've mentioned this before and I'm picky about my levels. We did not hit it last time. We came just a hair below 140 and then we bounced. This is the dollar yen over here. Anyway, and so we need to break 139.39 for the yen to really get going, for the yen higher to put in that weakness that is typically shaking a lot of that concentration risk in Mag 7. In other words, we have already experienced this July into the August 5th low, and that was muscle memory. The market will remember. Right now it's been very slow. In other words, the yen has been grinding higher since January 14th, and it has only recently pulled back a little bit. So the point is, I'm not looking for the next market weakness of size to come until the dollar yen breaks 139.39. That makes sense. So does that answer your question about, no, that was a dollar yen. Okay, now you want the 10-year? Okay, the 10-year. Let me show you a way of that I look at the 10-year that might be a little odd, but I'm going to do it anyway. All right, here is the 10-year T-note future. That's the bond, not the yield. This is the 2-year. And I got a little, you can see this kind of funky head and shoulders pattern, hasn't really broken lower. It's going sideways, and until we get some resolution on the debt ceiling, we're probably not going to get too much excitement, but I see yields moving higher. Right now we're neutral zone, but I see yields moving higher. Remember what happened with this dump in bonds on the 8th, which followed through very strongly. And then you know what happened. Trump came out and delayed the tariffs on the 9th because this was crashing and yields were moving higher. So I still see yields higher this year, waiting for this kind of these patterns to trigger lower. And this is going to be an ugly chart, but I'm going to show it anyway. And I do this because I've got fixed income clients that trade this yield curve, and this is the 10 and 2-year yield curve, and this is bearish steepening, not a bull steepening. So as this is moving higher, this is on a weekly, this is on a daily, and this is nightmarish over here. This is what happened on that fateful Tuesday before Trump came in with Bessent on the 9th to talk down the market, to talk down yields, and basically the Qs had a 10% up day that afternoon. Remember that? At 1:15 it started. I was live. I was watching this.
Wasn't it 12% on the NASDAQ?
I remember 10, but anyway, the point is it had a huge outperformance, and this is still chopping in a big sideways swath, but big picture, we still have this steepener going on, and it's a bear steepener, and I don't think bonds are going to stop falling until this indicator gets about plus 90 basis points. So I have my reasons for that, but that's basically it.
Does that worry stocks at some point, Samantha?
Oh,
Could
God,
that be,
yes.
as we look ahead over the next week, I'm not sure I see a whole lot going into expiry, but as we look for, sometimes a good exercise is looking for the potential landmark, that sort of, that one thing that can potentially hurt us and change the narrative. Right now, it's bid, the market's bid. What is that one thing? Is it higher rates?
It isn't one thing. It's a jobless claims above 287,000, and not just one and done, but it stays above 287,000. But first we have to hit 287,000. That will absolutely bring forward recession risk in market pricing. Number 2 is this 10 and 2-year yield curve. I've been tracking this, right? So I'm like, okay, I know where this is going. I know where this is going, but it takes time. Is once it triggers above basically 65 basis points, it's going to start to move up a little faster into that 90, which is bonds selling off, all right? Yields spiking higher. We're not there yet. This could be weeks, but the point is that's another level. My dollar yen, that 139.39, it doesn't need to just hag it. It needs to break and stay below it. Very market bearish. These are like levels versus just SPX, because honestly, market is going to follow follow, yields matter more. And with dollar crashing and yields moving higher and oil also falling, all those collateral trades are messed up. And then you have FX currency volatility like we had with the Taiwan dollar over the weekend, and you know that there are some imbalances. So that's what I'm tracking. And then I try and come up with, okay, what are the triggers that I'm looking for on a Thursday morning jobless claim print? Not a Fed pushing out to December will, of course, make the market realize you do not have an ally, right, in coming in to swoop in and protect you. They're going to wait as usual. They're always late, not once in a while, always late. So they're not going to be proactive, market get over it, move on. You're waiting and hoping that Besant and Trump will not fail. And so far, they do not have a stunning report card. So we're really just, I have to find other triggers to, I guess, guardrails as we're driving about on the corniches of France overlooking a cliff dive. There's really just these markers that I have. So dollar yen for me, jobless claims, much more important than SPX and Q levels, if truth be told. And of course, yields. So that's what I'm looking for. And I'm still bearish the dollar. Bearish the dollar for sure. Bearish oil for sure. And bullish yields. But yields haven't really gotten their mojo going yet.
Join Samantha and Hans at the next Macro to Micro Options Power Hour, held each Wednesday at 4 p.m. Eastern Time. Registration is free. Scan this QR code or click on the link in the description. Watch the full Options Macro to Micro Power Hour episode by clicking on the video here and subscribe to LaDucTrading YouTube channel for more content.